Thank you so much for joining us today, Steve.
Great to be here, Mia.
We wanted to talk a little bit about some of the undiscovered gems that Forager is really known for. So how do you define an undiscovered gem in stocks?
I think when we talk about undiscovered gems, it's really this concept of some variant perception that you see something in this business that is not implied in the market price at that point in time.
Can you give us an example of that?
Yeah, look, I think there's two extremes for us. There's what we call informational edge. So I understand a sector or a business better than other people. And yeah, a really good example for me here in Australia was Jumbo Interactive. It's an online retailer of lottery tickets where I think people really misunderstood the core business that was here in Australia. They had an operation that they'd started up in Germany as well, and that German business was losing a whole heap of money, and that was clouding the profitability of its business here in Australia, which was growing quite nicely. And we went up to the management team in that case and said, this is why your stock is trading where it is, and you need to fix these things to change it. But then we've taken that knowledge that we had about the online lottery sector in Australia, and we've parlayed that into another 3 or 4 investments in our international fund. So Lotto24 is a German company. The market's been exactly the same over there. And in fact, it came from Jumbo. When Jumbo was trying to grow their business in Germany, they said, look, there's a big player over there that's probably going to be the number one. And it turned out that company was listed as well. So we used that experience to buy that company. And more recently, we've invested in an online lottery ticket company in the US. That market is just starting to deregulate. So I think that's an example of informational edge, where we know a particular type of business really deeply and well, and we know what the market gets wrong in terms of valuing that type of company.
And do you always take such an active approach? In that example you gave with Jumbo, you changed what management was seeing in the market. Do you always do that?
I would say we've become more active as we've gotten bigger, because these investments for us, when we take bigger stakes in a company, it's harder to get out if you're wrong, and it needs to work. And I think Jumbo was an example of not really thinking enough about that on the way in. We invested in it because we thought it was cheap, and we took a bigger and bigger stake because we thought it was getting cheaper and cheaper. And then we realised we had to roll our sleeves up in order to realise that value. And I think that's become more common. And for us, it's become a part of our process to identify up front whether it's going to need that work or not, and whether we're willing to do it. And then I think the other big bucket for us of undiscovered gems or opportunity really is just the psychological side of it. When people are selling a stock that they actually know is cheap, but they're selling it because they're either fearful or they're forced to sell it. And we have a lot of filters set up in our business to try and identify those types of opportunities. Spin-offs, I think, is a really good example. BHP, a lot of Australian shareholders would know that company, and they spun off South32 4 or 5 years ago. And for us, we run filters to say identify every single company that's doing a spin-off like that, because BHP is giant, South32 is tiny, and there's a whole heap of shareholders that owned BHP that can't own South32. So they are forced sellers of that stock once the spin-off has happened. And
what are some of these other filters or psychological markers that kind of set up a little alarm for you?
Well, I mean, market-wide is just the big one. I think when there's a huge market sell-off and everyone is panicking, you can look back across Forager's history and see that it's been a strength of ours to be the marginal buyer in that type of market. And it's actually easier said than it is done. People don't panic for no good reason. At the time, there are usually good reasons for panicking, and you need a business structure and a fund structure and the support of your clients to execute on those things. And then I'd say there's lots of other smaller ones that are more frequent and less obvious sometimes at the time. So, spin-offs is a good example. I think index changes are another example of forced buying and selling that can cause discrepancies in prices. Other fund wind-ups, so where you've had an example of a fund that's had to wind up and sell all of its stocks, we will normally just go through every single stock they own and say, is there anything here that we're interested in? Because often the prices come down, and particularly in the value investing space, you've seen so much money come out of that sector over the past 4 or 5 years that there's been a lot of forced selling on top of willing selling as well, and that's created a lot of opportunities for us to pick up some bargains.
That's great. And on the flip side of that, when as a value investor, when you've got a stock that you really love, how do you know when it's time to sort of let go of that stock and start to sell it down?
Yeah, well, for us, I've really tried to change the whole mentality across the business. I don't want one person saying to me, this stock is a buy or it's a sell. The way we think about the whole world, and I think it's a mistaken way to think about it, the way we think about the world is what is the right weighting in our portfolio for this stock, given today's potential upside and all of the other opportunities that we have out there to invest. And we try and answer that question before we decide whether we're going to buy or sell. So we might be buying and selling, or we could hypothetically be buying and selling exactly the same stock because we are either underweight or overweight relative to where we want to be. So, we might have bought a stock, we got the weighting wrong to start with, it's working out really well, the weighting's gone up from 2 to 4%, and the company has doubled. Normally most people are sitting there, the share price has doubled, I'm thinking about selling. We might be sitting there at that point in time saying, you know what, this is going so well that the right weighting is 5% today and we should be buying it. And vice versa, and I think this has been the case over the past year. Some of our best ideas have performed really well. We still think they're fantastic opportunities, but the weighting in our portfolio has become higher than it deserves given the risk and reward that's in play. And we're selling a stock that we really hope does well. We don't want it to do poorly, and we're confident that investment is still going to do well, but we are marginally selling that stock because we want to get the weighting down. So
you have a weighting target and you just sort of shave away until you've hit that target.
Exactly right. And at some point that might be a zero, and it has become a zero with a lot of our stocks that have performed very well over the past year. So people would look at that and say, well, you've sold it all and you've had good reasons for selling it. But for us, it's been an incremental process from a 5 weighting to a 4 weighting to a 3 weighting to a 2 weighting to a, you know what, this is just not worth having in our portfolio at the moment. There's better opportunities out there and we want it to be zero. And we've had examples over the past 6 months. Farfetch is a great one for us. That is a business that we absolutely love, and Chloe picked it up when the share price was $18 and it was really misunderstood.
That's one of your analysts?
Yeah, that's right, an analyst on our international fund. This would have been, it was well after the bottom of the market back in March, probably June or July last year. And Chloe pitched this idea and said, I think this is a wonderful business and it's misunderstood. People think it's just an online retailer. I really think it's a platform for these luxury companies to sell their products. And there was an interesting, just as an aside, an interesting insight into that business, that it doesn't actually buy any inventory and sell it itself. It literally runs a platform for these boutique luxury stores around the world to sell their product online. So you go there as a customer and you see all this product, but behind the scenes there might be 20 different luxury boutiques that are providing their inventory, and they will take the order at Farfetch and then send an order through to the boutique, and they pack it up in a Farfetch box and they pick it up and deliver it. But as a business model, not having to hold all of that inventory is fantastic. So, we invested in that at $18. It ran to 70 with all of the madness of February and January of this year, and at that point we were a zero weighting, and it's back in the 40s now, and again it's a 1 to 2% weighting for us at that sort of price. So you can see how that works there. It's not a buy or a sell, it's a where do we want the weighting given the price that's in front of us today.
That's great. And looking back over sort of, the past year or so, what's been a really standout stock for you? Is that, the number one?
Not even close. It's been a pretty extraordinary year across both of our funds. Celsius, which is an energy drinks company in our international fund, has been one of the most successful investments. It wasn't my idea, so I can't claim it as mine, but one of the most successful investments I've been a part of. That stock is $5 in January last year to more than 70 today, and was trading more than 80 quite recently. And share price is one thing, but the business is just growing really, really nicely. They sell energy drinks to health conscious consumers is their pitch, and historically energy drinks has been a very, very male sort of computer game, extreme sport driven space, and they're marketing to a younger demographic, to a lot of females, and they started out actually in gyms, and they've just overtaken Red Bull on Amazon as the number 2 selling energy drink on Amazon. The growth rates are fantastic. So share price is wonderful, but it's more enjoyable to see the businesses going well like that. So that's on the international side. And then in our Australian fund, Mainstream, again, it's been a great year and it's been one of the most successful investments, and I can take a bit more credit for that one. It's a stock we've held for 5 years, and we actually were really confident the value of that business was growing, and the share price went absolutely nowhere for 5 years. In the past 12 months, it's gone from 50 cents to a takeover battle between two companies that's recently hit a high of $2.76 a share, and is looking like it's getting closer to the end, but isn't over yet either. So yeah, that's a stock that we've made 5 times our money off over a 5-year period, but it's all come in the pace in the last 12 months.
Great. I wanted to talk today about the journey of an investor, and there's always a period as a long-term investor where you have some tough times and down years or months as it might be. Tell me a little bit about Forager's journey and what are the lessons from the tough times?
Yes, my most hated word of 2021 is humbled. You're seeing it all over Twitter. People are humbled when they win a prize and they're actually quite proud about it. I think humility comes from things like happened to us in 2017 and 2018 where things go horribly wrong. We started the business in 2009 and our Australian fund in particular had a really good track record up till 2017, and then a couple of really tough years that I think have been the making for us as a business, and even I think from an investment philosophy perspective we've had to make some adjustments that have made a very big difference. I guess firstly, what went wrong? I think there's two aspects to it. One, just on the investing side, we were being aggressively contrarian all of the time. And that had been very successful for us on a number of occasions. And I think we went into a market environment where there wasn't a lot that the market was doing stupidly or doing wrong, and most businesses were priced fairly. And we were really trying to push the contrarian nature of what we do and look for contrarian opportunities for the sake of it. And that caused us to make a couple of mistakes. And I think it was a time for just being conservative and running a balanced portfolio and waiting for the opportunities to come back to us that we specialise in. So that was one. And then I think from a business perspective, I dramatically underestimated how different it is running a funds management company from actually just picking stocks. I think we grew quickly and the fund got bigger, and we didn't necessarily grow as an organisation in a way that was able to deal with that growth. And 5 years ago, we brought in a CEO, and 3 years ago, we brought in a new director and shareholder into the business with a lot more experience than I had in running businesses. And for us, getting the incentives for staff right, we changed the fee structure on our international fund. We actually cut the base fee at a time when we weren't going well and said we're going to introduce a performance fee here. And we attracted some new staff on the basis that we now have a performance fee and we're going to be able to pay you really well if we do really well. And really tried to set the business up in a way that was scalable beyond one person just going out there and picking stocks. And I think you can see the evidence of that working in the fund returns over recent years. And if you look at our international fund, it's done 40% better than the index over the last year, and there is almost not a stock in there that was my responsibility for finding it. So maybe the solution is for me just to get out of the road, but I'm actually really proud of it. I'm really proud that we've been able to attract people, train them and develop them to a point where that fund is generating outstanding returns without me picking the stocks, because that says to me we've got something here that can now live for 20 and 30 and 40 years through a process and a culture and an incentive system that works rather than being dependent on one person.
Yeah, well, retaining, really good talent is a very difficult thing to do, and building that culture as well.
And I think as a client, it's really hard to see from the outside. A lot of funds management companies are quite dysfunctional organisations. The skill that it takes to pick stocks and be really dedicated to that, they very rarely transfer well to managing people and growing a business. So you find these people that are great stock pickers and great fund managers that are then trying to run a business, and it's hard. And I think that's hard to see as a client from the outside. You often come across a fund that's 5 or 6 years old, the performance looks great, and you sit there and think, well, this is going to be a great thing for me. And then 5 years later, you realise that wasn't as scalable or as repeatable as you might have thought at the time you invested in it. And from the inside, I can tell you it's a real challenge trying to get those things right. Fortunately, I started the business when I was 30, so we've had time here to make a few mistakes and get a few things wrong, and still have some really loyal clients that have done well out of the funds as well. But we're at an age now where I think you can expect us to be a bit more mature, and hopefully an organisation. I would love to look back at the end of my life and think that there's a group of great fund managers that have come through our business and learnt the tools of the trade and done really well.
I wanted to talk about what are the great qualities that a stock picker has or an investor should have?
Yeah, I mean, it's a really interesting question because I think it is different, and one of the things that we have learned over the past 5 years is that picking stocks when you're running a small retail portfolio is very different from trying to run a fund at a larger scale. I think there's two things that I've seen be very, very successful. One is just really focusing on the type of business and the management team and the type of stock that you want to own, and narrowing the universe down to a fairly small list of 30 to 40 businesses that you really like and you want to own, and then just being really patient and waiting for the market to do something silly and give you the opportunity to add those to your portfolio. And I think that suits a certain type of personality. And then at the other end of the spectrum, it's flipping that equation on its head and saying, where are the opportunities at the moment? Where are people doing something that I think is stupid, or where are they possibly overreacting? And you actively go and look for new opportunities all the time in that space, and you just turn as many rocks as you possibly can. And I'm more inclined towards that end of the spectrum in terms of how I pick stocks. And I'd say we've got a blend of things across the team, but I think at that end of the spectrum, you need to be very, very wired for that concept that I talked about earlier of some sort of variant perception. You can't afford to sit there and spend 2 days researching a stock just because you're interested in it. You need to turn lots of rocks and say, okay, this is a prospective area. Let's take oil and gas at the moment, for example. It's a space that no ESG fund wants to invest in. There's a huge amount of money coming out of it. The index weighting of oil and gas in the US has gone from 15% of the index down to 3%. So it's a completely unloved, untouchable space. I would say, it doesn't mean I want to necessarily invest there, but I would say that is a prospective area for me to go and look. But I don't have the time to go and do a full valuation and research piece on every single stock. So you get into this process of, I'm going to flip a lot of rocks and I'm going to quickly make a decision about whether this is an attractive opportunity or not. And I'm going to have a really high, I want a lot of errors where I toss out a thing that ultimately does well, and I don't want many errors where I focus on something that doesn't work out well. So it's highly selective, and the people that I've seen that are really good at it are wired to care more about whether as an investment it's going to work out than they are interested in the business. I think interest in business is really important from an investing perspective, but sometimes you can actually spend too much time being interested in business and not enough time being interested in, is this stock going to work for me or not?
How many stocks would you look through in a given day or week, or how many rocks are you turning over? Me
personally, not that many anymore, because my job is to steer the team around the park and make sure they're looking in the right places, and I spend a lot of my time reading their research and their ideas and trying to help that decision-making process around, is it a great idea or not? But I think a good stock picker, you'd be looking at least 20 stocks a week that you hadn't looked at before, and more importantly, I think you're looking in the right sorts of places to find those ideas. So yeah, you might be across 100 in a week, and you narrow that down to 20 and you spend a bit of time on those, but you are looking at lots and lots and lots of different types of businesses, and it's pattern recognition. Is this in one of those spaces where I feel like I've got an informational edge, or is this a setup here where I think there's some psychological edge? If no, chuck it and just move on to the next thing really quickly.
Fair enough. One question we like to put out is a hypothetical portfolio of $1 million. So if you had $1 million to allocate today, what sectors, what kind of percentage allocations, what would you look at in a portfolio?
Well, if that was all I had to do, i.e. I didn't have all of the other money that I have to manage as well.
Very different scope, yeah.
The portfolio that we have is obviously the best list of opportunities that we think is out there at the moment. So we have allocated that portfolio, and people can go and look at our top 5 and 10 holdings, and it wouldn't be dramatically different in terms of doing my job. But I would say to everyone, if you're managing a really small amount of money, the universe that you have available to you, even compared to me, we are small by funds management standards, and we want to stay that way because it gives us a much bigger universe than a larger fund. But if you're down at that size, only $1 million, then your universe is 10 or 20 times what ours is. And I think you should be looking at that even smaller end of the spectrum for even more mispriced types of opportunities. And I think you've got the luxury at that end of the spectrum of being able to buy less picked over but better quality businesses that you think can grow for a long period of time. And I think, again, at the moment, the market's turned a bit sour on some of these growthy, high quality businesses, and I think there's plenty of opportunities out there for you to be looking at some smaller ones of those that might be 10 and 20 baggers, i.e. you make 10 or 20 times your money over the next sort of 10 years. And I'd be picking through that pretty carefully, and I would be running quite a concentrated portfolio at that size as well. I think you can as an individual investor and it's only the one of you, I think you get a lot of diversification benefits. If you can put 10 or 15 quite different businesses into your portfolio, it doesn't really need to be 30 or 40. And if you don't have any liquidity constraints, I don't think that 30th and 40th opportunity is really adding much to your portfolio.
Tell me what kind of issues you're seeing in the market today and what you and your team are really grappling with or debating at the moment.
I mean, it's been the headline of the newspaper and The Economist for the past few months, but inflation, I think, is the big one. And I think it's bigger than usual, and the reason is because the world has priced a whole heap of different asset classes, not just equities, but housing and debt and government bonds, and all of these different asset classes are priced like interest rates are never going to go back up again. The discount rates that people are using in equities are very low. The discount rates on some bond markets are negative, and I think though the reason it is such a big question for people is because its impact is going to be so significant if it does rear its head. And we wrote, it was in our December quarterly report, I felt like markets were not pricing in that risk at all. I think now there's a lot more awareness of it, and I think it's a more balanced situation where a lot of people are thinking about it, and I think the assets that will benefit in an inflationary environment are now trading at much higher prices. So I feel like it's a pretty even trade-off at the moment in terms of risk and reward around that inflation issue, but it's a really, really big one that we're going to watch really closely, because you are going to see data this year that is going to scare you. Like the short-term inflation numbers are going to be high, and you're going to see headlines where everyone's going to be saying inflation is taking off. I don't necessarily think that means the past decade of low inflation, high debt levels, shrinking populations. There's all sorts of reasons why people were saying inflation is gone for good that haven't yet completely gone away. So look, I think the risk is there and it's high, but I'm not convinced yet that it is certainly going to happen. So we're really trying to balance a portfolio and say, we don't know the answer to this. I don't think anyone does know the answer to it. We want to try and run a balanced portfolio that's not going to get punished too badly in either scenario. And if we get more and more evidence that one or another scenario is more likely, then we're going to make the appropriate adjustments to the portfolio at that point in time.
And what evidence are you on the lookout for?
Well, it's going to be hard because I think you're seeing shortages in supply chains, prices are going to be up. So I think over the next 3 to 6 months, it doesn't really matter what you're going to see. I think it's looking for signs of that becoming entrenched, and wage inflation is it's been the missing ingredient for the past 10 years. I think if you start seeing expectations and wage inflation increase, then that becomes the self-fulfilling mechanism that can cause lots of problems. I also think to the extent that central banks need to raise interest rates, it's become kryptonite effectively, right? The days of putting interest rates up from 5 to 10% to slow the economy down, I think you have the same effect these days putting interest rates up from 1 to 2 because there's so much leverage in the system. So it's going to be a very interesting few years on that front, and I wouldn't say we have a strong focus on either scenario.
If we are moving into a more highly inflated environment, what then are you going to do to the portfolio? How are you rebalancing it?
Well, I think you're seeing a lot more focus on the commodity stocks out there, and it's been an unloved sector for a long time, so your starting point was cheap. And I think that traditional value stuff has underperformed for a very, very long period of time, and I think less so actual inflation, but the economic environment that's going to create inflation is going to be quite positive for a lot of those stocks. And I think people are underestimating how much profit they might make out at the other side of this. There's been a lot of cost cutting. These businesses have been cut to the bone, and if you finally get the demand side of things filling in here, some of these businesses will be very profitable. So yeah, we own companies like Linamar in our international portfolio. Banks, I think, do quite well in that environment. They've been struggling because of low interest rates. We own Lloyd's in our international fund. So yeah, we've got exposure to some of those businesses, and it's probably all about increasing that exposure. Yeah, traditionally you go back to the 70s and businesses with pricing power were great hedges against inflation because they just put their prices up to compensate it. I think the challenge at the moment is most of those businesses with pricing power are priced for very low interest rates for a long period of time. So they're expensive, and they're expensive because people think interest rates are not going to go up. So In those situations, you might be able to hold your profitability because the business keeps putting their prices up, but you get whacked on the other side with multiple compression because people start applying higher discount rates. So I think that playbook from the 70s may not work as well this time around, and we're probably more focused on the commodities financials side of it for some protection in our portfolio.
What about long-term challenges? Are there any things in the, we talked about the medium-term inflation. Are there any things in the far long-term that you look at and identify and worry about?
Not really, because I think the world is extremely variable, and there's going to be a lot of things happen that we just don't anticipate today. And for me, those have been the situations in which we have thrived. So I try not to forecast too far in advance. I am an optimistic person. I look at what's happened over the past 18 months, and 25% of the world's population has today had at least one vaccine shot inside 18 months since that virus was discovered.
It's pretty amazing.
If you go back just 20 years, the amount of time that it would have taken to find, develop, test a vaccine was just extraordinary. And I think this technology around RNA is just an extraordinary leap forward for humankind. So I'm a relative optimist about how adaptable and creative we are when we're forced to be as a population. So I'm not someone that's sitting there worried that the whole world is going to collapse. And then from an investment perspective, I would say our number one competitive advantage has been really being realistic about how much we don't know. We sat there at the start of COVID last year and we said we've never seen this before. We do not know what's going to happen. This might be another Great Depression. It might not be that big of a deal. Maybe there's a government. There's all these different things that could happen. And to be honest with you, even the things that we did think would happen, we largely got wrong. I mean,
what was your strategy?
We own a motorbike retailer, for example, and I would have assumed that motorbike sales were going to get hammered because people had no disposable income and didn't have jobs, and they're not going to go out and buy motorbikes. And it's been the best year that business has ever had, and you've seen that across consumer retail all the time. So your question was, how do we handle it? And I think recognising what you don't know is really, really important. So I like to think about the future as this whole sort of cloud of uncertainty that you just don't know what's going to happen. And even if you do think you know what's going to happen, be prepared to change your mind tomorrow, because there's every chance that you're wrong. And because we start from a position that we don't know what's going to happen, we are alive and aware to a lot of different opportunities. So as we get evidence here, let's change our minds. And as that cloud sort of focuses down on a particular scenario that we get more confident is going to happen, let's aggressively try and pursue that rather than trying to predict all of that in advance. So, as we were in March of last year, there was a huge amount of uncertainty. We're contrarian investors. We like buying when there's a lot of distress. So my message to the team is, let's make sure we step in the right direction, but let's be careful here. So our first purchases were very resilient, reliable businesses with strong balance sheets that weren't going to go out backwards. Companies like Autodesk in the international fund, for example, even in our Australian fund, Star Group, the casino businesses that we were really confident were going to be here no matter what. And then I think by May or June, you had a lot more information about how the world was going to handle this and how individual companies were going to adapt and change. And investors, yes, the rebound was quick, but I think people clung to their preconceived ideas for far too long. I think in May and June, we were much more aggressive about moving to the riskier end of the spectrum. And I think the people that were negative in March found it really, really hard to take the evidence that things were going fine by May and June and take advantage of that. So we moved more into businesses like Motorcycle Holdings that I touched on earlier, that by that point in time had come out 3 times and said, things are fine, things are fine, things are fine. Eclipse, I did an interview with Livewire in March saying, look, this business is high risk, but I think it's a really interesting opportunity. By May and June, secondhand car prices were up, not down, and the company was out saying, we're generating lots of cash flow and we're fine. And the share price was up, but nowhere near up as much as it should have been. So it's really trying to accept that the world is unknowable and that the future is uncertain and wait for opportunities for things to be mispriced. And being willing to change your mind is a really hard thing, but it's something we work particularly hard on.